These are all, little bits of revenue that help grow the net operating income. And ultimately, cap rates are not necessarily controllable, but every dollar of net operating income is going to increase the value of the building. So every dollar does count.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Jack and Zack are both here today, and we're going to talk a little bit about economics. We're going to talk about cap rates. We're going to talk about inflation data and transaction volume. We do have some slides, so if you are listening and you want to see the slides, remember to check out our YouTube channel for jkaminvestments.com. It's where we host all the Alternative Investor Mastermind podcasts, so check that out, like and subscribe. For those that are listening, there's still plenty of content that we're going to talk through. So Zack, thanks for coming on today.
Yeah, of course, Jack. I mean, it's a very interesting time here in commercial real estate. So certainly have a lot to talk about.
Yeah, we do. I think the first headline that we're going to talk about is that quarter one of 2024 had the lowest deal volume since the peak of the pandemic.
Yeah, that's right. And, it really seems like from all the data that we're looking at, and let me know if this is what you're seeing as well, buyers and sellers just aren't agreeing on anything. And there aren't enough sellers yet that are so motivated to sell that they're willing to budge on what they think their property is worth.
Yeah, I mean, that's dead on. And we've seen, some of the transactions we have seen are trading 25, 30% lower than they were at the peak. So a lot of sellers were potentially testing the market. There's definitely been some deals that were even under contract at much higher numbers. And then when they didn't close, the pricing is just reset. Really, the only people that are selling right now are forced to sell. Either they have a balloon payment coming due and or their fund is at maybe the end of the life cycle, or they would need to write a check and do a cash in refinance right now. So largely, other than life events, most of the sellers now are somewhat distressed. Even if the properties are not distressed, they're distressed because of their capital stack. And anyone who isn't forced to sell is likely better to wait. All signs point to rates should be coming down over the, at least by the end of the year. Pretty much the market's pricing in some type of rate cut. So, I think we're going to see this dislocation probably for the next 6 to 12 months. And at that point, a lot of the bridge loan debt is going to work its way through the system. Either they're going to sell or they're going to find a way to refinance. And then I think we'll be in a little bit more traditional market where the transaction volume likely increases.
Right. No, I think that makes a lot of sense. And that's why, we are seeing cap rates increase steadily, but we're not seeing anything, I would say, too dramatic happening right now. Is that largely because, of what the expectations are around interest rate moves?
Yeah. And I think cap rates have not moved as much as the short-term rate has moved. Cap rates, the interest is not part of I actually had this conversation with an investor the other day. And, when you calculate the cap rate, the interest rate is not part of the calculation. However, when interest rates go up, it does raise the overall cost of capital and it affects what the total returns are for a potential buyer. So they're definitely factoring it into where the prevailing cap rate is going to be, even though it doesn't actually participate in the formula itself. So cap rates have risen, but not nearly as high. The short-term interest rate went from 0 to 5. And I'd say cap rates have probably went up about 1.5. So maybe a 1.5% increase in cap rates versus a 5% increase in the short-term rate. And part of that also has to do with, the cap rate is a piece of the cap rate is also long-term debt. Only a subset of the market was really using short-term bridge loan debt. So other than kind of peak COVID, where the 10-year got under 1 point. I mean, the 10-year was always, higher than the short-term rate anyway. So where the 10-year might have went from the twos, 2.5s to now in the mid fours, the 10-year went up 1.5, 2 points. Cap rates have went up 1.5, maybe 2 points on certain subsets. So, it's somewhat correlated, but it doesn't move. It certainly doesn't move dollar for or point for point.
Sure. No, I think you're right. I think you hit the nail on the head there. And Jack, can you say a little bit more again about interest rates, how they tie into cap rates, why buyers and sellers aren't agreeing, and what that really has to do with, of course, where inflation is right now, but also, what a lot of the partners that you're talking with on a regular basis, what they're able to make pencil and what they're not as a result.
Sure. So, most investors, whether it's a family office, whether it's a fund, whether it's a syndication group, they're all trying to make, on average, a mid to upper teens overall return over a 3 to 5 year period. And, a lot of things factor into that, but cost of capital and cost of debt is certainly a relatively big component. Most properties are financed, 55, 60, 65, 70% of the purchase is generally financed. So that's a big overall part of expenses. So when rates do go up, it increases that's a big part of the expenses, and you need to factor that into what the total return is. So the higher the interest expense, generally the lower you can purchase a property, and the lower purchase price that pencils is going to equate to a higher cap rate at acquisition. So that's one of the factors. There's a lot of levers to pull, and it gets very complicated. You have to factor in, if rates are going to stay high over a few years, what is the cap rate going to be, and what would a buyer pay 3 or 4 years from now? Now, if rates stay high and inflation stays high, likely rents are going to go up as well. There's a number of expenses they're going to move with inflation, and rents are definitely one of the biggest ones. At the same time, operating expenses will generally go up a bit as well. Salaries for employees will go up. Cost of materials may go up. Cost of utilities, if there's any owner-paid utilities, may go up. So, there's a lot to track and a lot to figure out, and a lot of estimates, if you will, on where things will be in a few years. And a lot of that is just really not able to be controlled. What we really try to hone in on is things that we can control. And for the multifamily space, it's really, what is the value add component? With a renovated apartment, how much will the rent increase from a classic unit that's maybe 10, 15, 20 years old to something that's a little more desirable with, say, new kitchens, new bathrooms, new flooring? And that's something that, if you can control it, and and you've bought correctly, it should lead to a successful deal regardless of what happens in the economy. So that's something we really try to focus in on, and we really preach to our passive investors, and we really dive in when we're working with any of our operating partners on making sure that part is as airtight as possible.
Right. Yeah, no, I agree. And I think, we were talking about this a little bit earlier, is that there are so many variables right now that are in play between, again, this kind of stalemate that we're seeing in terms of new deal flows, new transaction volume. It's really extended the timeline for a lot of the deals that we're looking at. What used to be, in some cases, a 1 or 2 year hold is now a 3 to 5 year hold. What was it, 3 to 5 is now 5 to 7. Can you talk a little bit about, timelines and how the value add strategy is changing? Maybe, is there more value add that is being done in a lot of or at least proposed in a lot of the properties that you're looking into when it comes to, more ways to generate more value?
Yeah, certainly. And there's two different camps here. We have some deals with long-term fixed rate debt that, had the option to go 7 years, and now that, but with the option to potentially sell earlier. And with rates where they are, those deals at this point, there's really no incentive to sell earlier. So, it's in some cases they're revisiting the business plan, and they're looking for other avenues to increase the curb appeal, increase the desirability. And given how hard it is to buy a house right now, there's really appeal to the best available tenant base possible. That includes things like adding a dog park for properties that are pet friendly, making deals with internet, cable, television providers to get a bulk discount, buying or leasing washer and dryers, and adding an additional rent charge for those. We've seen all sorts of creative strategies. One of the more common ones, if the utilities are not separated, there's a thing called RUBS, where you could separately meter the utilities and start charging the tenants their actual utilities, and that nothing holds people accountable like paying for their own electric bill. Whereas if they weren't paying for it, maybe they leave the lights on all day, put the heat at 80. Just flashing back to, I'm sure many of us have had, that conversation with our father when we were, 10, 12 years old or whatever, where he's like keeping the thermostat either too hot or too cold, and
Sure.
arguing about it when we're not paying the bill. And then the other camp is deals that were expected to be 1 or 2 year deals. And we're in a number of those deals as well, where, including, with groups that we successfully exited previously in, a year and a few days. And, now those deals have to refinance or extend the current loan. So, that's a challenge. And a lot of these deals, the original plan was just get in and out, renovate a bunch of units quickly, and show the proof of concept, and then let the next group come in and do that heavier lift over 3 to 5 years. So, in that scenario, we've seen a pretty big pivot. One of our main operating partners really took all of their acquisition people and a lot of their staff and just refocused them on asset management and property management and oversight, just to make sure that they're really have a long-term mentality and are able to implement a lot of the same things I mentioned. It's a pretty standard playbook for adding value, making it as desirable as possible, doing things that create win-wins, like create a discounted internet package that the cable or internet provider will give the ownership a piece of. Insurance is another one, renter's insurance. I know there's groups that'll actually participate with a landlord to offer their rental insurance through their property portal. And these are all little bits of revenue that help grow the net operating income. And ultimately, cap rates are not necessarily controllable, but every dollar of net operating income is going to increase the value of the building. So every dollar does count.
Sure. Yeah, no, and Jack, the next thing that I want to talk about here is just kind of how all these different variables that we're mentioning, these different value add strategies, again, deals being able to pencil or not, but also you just mentioned, different things that some of the larger groups are doing. I want to pivot a little bit to REITs on, the much larger side of the business. Something that, a lot of investors are curious about is, basically the diversification that you get from a really large REIT that, seems to have minimal downside. But I'm actually going to move to the next slide here. It seems like there are REITs that are in quite a bit of, we'll say they're having a bit of a tough time of managing their cash flow, redemptions. Is part of it, because they're a bit too big in some cases?
Yeah, that could be part of it. And, the people that like REITs generally like them for the liquidity, and or they're just not even as familiar with the private placement market and private funds. And, often I think they don't realize that you're paying a price for that liquidity. Right now, a lot of REITs are trading well below their net asset value, meaning if you owned them outright, might be worth a market cap of $1 billion. But if you add where the stock trades today, it might only be valued at $800 million. So if you're gonna sell immediately, you're still selling at the bottom, because Wall Street is not pricing in the full value of the portfolio because of negative headlines like you just mentioned. And because when there's significant redemptions, the REITs are either forced to either borrow money to pay for the redemptions, which is basically robbing Peter to pay Paul, or they need to sell assets. And as we said before, now is not the optimal time to sell assets. So actually, one of the deals that our fund invested in last summer, I believe, was one of either Blackstone or one of the major REITs was forced to sell something, and they chose to sell this asset because they had redemptions. So they sold an asset at I think in opportune time for us as buyers, but in a perfect world for them as seller, they'd probably have been better off holding that for 2 or 3 more years and waiting for interest rates to calm down and a little more certainty in the market. So it's got its problems, and as I've said this probably on 10 other podcasts, but I want to keep saying it because it's super important for higher earning, higher net worth people. Owning REITs is not usually tax efficient because REITs are taxed at ordinary income because they're not qualified dividends. So higher earners are probably paying 29.6% tax on their dividends. Whereas in a syndication or a private real estate fund, you're getting tax deferred income because you show a loss on paper, even though you're getting cash distributions in your pocket. So I'm going to probably repeat that 10 more times. I think it's super important for those to see. And I think many who maybe have money with a traditional financial advisor just may not even realize it because it's buried in the tax statement. And by the time they're getting their taxes done at the end of the year, they may not even realize when they have to pay exactly where that number is coming from.
Yeah, no, you're right. You're right. And so, I think there are a number of reasons why REITs might not be the best opportunity for someone looking to invest in real estate out there. And again, they might have a number of properties that are performing well, right? That are have good occupancy rates, that are showing rent growth, that are executing a value add strategy. But for reasons within the portfolio or greater macroeconomic reasons, there's a number of redemptions taking place, and therefore, you might be receiving smaller dividend, paying a higher tax, and taking a hit even on principal in some cases if you're having to pay at a discount. So it really takes away a lot of the safety and security that a number of investors are looking for when making that kind of a decision. Especially because from what we're seeing, at least a lot of the types of properties that we're tracking, Jack, take a look at this here. We focus heavily on Class B value add, and I mean the state of the market shows that vacancy rates in this asset class are about as low as it gets in the industry right now.
Yeah, and there's a reason this has been our favorite asset class. The highest end Class A when there's a recession, usually takes the biggest hit. It's also where most new construction comes in. So when you build, most of the time it's unaffordable. You really can't afford to build anything but the higher end Class A with the cost of materials and the high interest cost these days. So when new supply comes in the market, it generally hurts the Class A the most. And at the same time, Class B. Here's a real example. I was just in Phoenix recently for a conference, and we took a bus tour and toured a number of properties from one of our partners, and all the Class A was renting for $2,200 to $2,600 when it came on market. But the properties that were workforce housing, were as low as $1,000 to $1,100 and potentially as high as $1,500 to $1,600 after renovation. So it's impossible to build something that you're going to rent for $1,500 or $1,600. So at the same time, there's a whole segment of tenants that can't afford $2,300, but they could afford to pay $1,500, $1,600 for a nice place that is newly renovated. Now, maybe there's a few tenants that were in the $1,600 that'll stretch to $2,200, $2,300. They get a new job, they move in with a spouse and could afford a little more. So maybe the top few percent of the tenants will trickle up to a Class A, but it really is not as significant. We've seen it hasn't been as significant as we may have feared. And at the same time, when you have record low unemployment, there's also some people moving up that were in a Class C property and are earning more, have more buying power, and are moving up into that nice Class B. And again, maybe they can't afford the $2,300 a month, but they went from a $900 a month Class C into a $1,400 a month Class B that's newly renovated, and we're providing a great service to that part of the market. and there's a lot of desire for just a solid, clean, nice place to live with newer renovated apartments and also exterior features like dog parks or upgraded swimming pool or just conveniences that make sense to for people that are just looking for a nice place to live.
Right. Well, going off of your point about Class A, about the rents being high, about how a lot of existing Class A becomes Class B with more supply coming online. I mean, you and I were talking right before the show. Over the next few years, the next year or two, there will be new supply delivered. But as interest rates have moved, we're actually, I mean, it looks like there's a lot less new development being proposed and being built at the moment to come online in 2025, 2026. Because of interest rates where they are, it's hard to pencil in the costs of building, again, new inventory into the multifamily space.
Exactly. And I've heard this both from, boots on the ground sponsors in major markets like Phoenix and Dallas, as well as a number of economists. I think we may have them on the show in the future, but I've actually reshared a lot of Jay Parsons' comments on LinkedIn, who's an economist. And essentially anything that wasn't already going vertical and built before everything kind of transpired over the last few years of rates is likely not going to get built. The actual new permits for new construction are down either 70 or 80%. So really hardly anything has broken ground in the last few years. The stuff that's coming online right now started, either pre or, during COVID and, really got going kind of during the 2021 reopening. And those are all hitting the market now. So this is probably, max supply over the next 6 or 12 months. And it may push down kind of the former A into an A minus, maybe a B plus, but I don't see those rents going from, the previous rent from 2,200 dropping to 1,600. It's still, I feel like the Class B, the workforce housing that we're generally investing in is generally a different ballpark than what's new. And the fact is, when you fast forward 2 or 3 years and all that supply is absorbed, there's, we'll probably see increased pressure in rents again. And again, if there's a major recession, that may change things. But if there's a major recession, rates will probably drop faster. Mm-hmm. If we have a continued strong residential housing market with limited supply and, these major markets where we have some of our assets are really the only ones with a lot of new supply. When you're in the Midwest or other areas, there's not as many areas that have been built out as well. A lot of the southeastern markets we have some new construction, but nothing like Phoenix and Dallas. So I think we're going to see markets where there's somewhat limited supply of apartments as well, because residential single family homeowners are locked in, and without new apartments, there's only so many doors. There's only so many places people can live.
Yeah, no, and I'm glad you brought that up, Jack. And I actually, moved to another slide here because you hit the nail on the head in terms of, again, how rents are stabilizing, how there is really very strong apartment absorption in a lot of the markets that, at least that we track. There are still some markets that are being hit harder than others when it comes to rent stabilization, when it comes to, net unit absorption. But a lot of what we're tracking year over year, again, rent growth is stalled a bit, but it is still quite stable, right? We're definitely not seeing anything falling off a cliff. We're not seeing, buildings with low vacancy across the country. And a lot of that does come down to just the lack of new supply coming into the market. These are strong rents that we're seeing.
Yeah, you're 100% dead on. And, we've even seen, something was published that rents were down in Phoenix as an example. But at the same time, on our actual units and our submarkets at the lower rent tier, it's something we haven't seen either. So, obviously every statistic can be spun a different way depending on the time frame you're using. But overall across 40 plus different investments, what we're seeing is rents are remaining strong. The value add especially is still being obtained when you take an old unit with, an 80s vintage and put nice new kitchens, baths, fixtures, stainless steel appliances. Those rent premiums are happening because there's a real demand from that. that group, and then those units are getting rented and staying full. And we're not seeing a significant amount of distress across various submarkets, largely growth markets like Southeast and Sunbelt. But I just saw a report for an Indianapolis asset where again, post renovation, very strong demand for the newly renovated apartments with significant rent premiums.
Yeah, I mean, we're very much in a buyer's market now. In prior years, we saw cap rates compressed heavily. Everyone was trying to beat inflation. Especially again, like you said, throughout COVID, there was so much uncertainty and there was so much capital flowing into the system that it was really hard to find a 5 cap. And now no one is buying anything below a 5 cap in most of the markets that we're tracking. And it's a good time to be a buyer because there's just so much. I guess the way that I would put it is you can be very selective and you can look for, like you mentioned, the distressed sellers who are selling good assets with strong rents, vacancy, quite low, strong occupancy numbers, growing markets. Like you mentioned some of the markets that we're tracking. I saw earlier that the Carolinas, throughout parts of Texas, Georgia, Alabama, Tennessee, markets where people are still moving for quality of life. The Appalachian lifestyle, I think I saw, as it mentioned in CoStar, where people are moving and they're absorbing supply just as fast as it can, actually faster than it can be built.
Yeah. And again, I think those trends are going to continue. I mean, there's been a trend of move into the Southeast for, a generation. And I think it's only continuing, and COVID pushed it a little forward. The ability for a higher percentage of the population to work remotely is strong. And then, the reshoring of manufacturing. There's a, number of new auto manufacturing, logistics. There's just so many companies moving and industries that are doing a little bit more onshore than offshore just because of some of the geopolitical things. So these are a lot of positive tailwinds for the economy, both in the Southeast and the Sun Belt.
I agree. So, Jack, now that we've gone through quite a bit, what is the last thing that I guess you want to leave our listeners with? We're looking 3-5 years down the line. Again, we're talking about absorption of new construction being built, talking about rent growth stabilizing, the potential for interest rate moves in the future. What is something that you want the people listening to the show today to think about for where they are in the real estate investment cycle 3 to 5 years from now, to take in mind right now?
Yeah. So I've had a lot of people who I know, whether they're new to real estate or they've been in a long time, are reverting to talking about trying to time the market. They're afraid that we're not nearly at the bottom yet. And I think it's the wrong mentality. Residential is likely not crashing. So if you've been on the residential side and you weren't as active in commercial, if anything, now is the time to sell. You're still likely towards the peak. There is still a supply shortage. And I think, those that are heavy in residential may want to take some chips off the table, and whether it's through a sale, through a 1031, and pay more attention to commercial. Because if you're trying to time the market, this would be the time to dive into commercial. I think you had a cap rate slide, but if you look at where cap rates are in general right now compared to the last 10 or 15 years, cap rates are the highest they've been. And, this chart goes back to 2018, but I'd be willing to guess they're probably roughly as high as they've been since 2010 or 11, since the end of the great financial crisis. And, this is a combination of just uncertainty in the market about interest rates and a small but influential part of the market that has variable rate bridge loan debt that's distressed. The fact that the only sellers that are generally selling right now are somewhat motivated sellers, either because they have a balloon payment due, because they have a variable rate interest rate that's increased, and their choices are sell or refinance, and their refinances may include a cash-in refinance, which some of the sellers just don't have the wherewithal to do. So I really do think now is the time to jump in. And as far as looking forward, none of us have a crystal ball, but when you have the highest cap rate that we've had in many years, there's a lot of cushion. If rates do come down, even a point and a half, cap rates probably come down a good portion of that. And that increases the value by millions of dollars on most of these deals. So you could very easily have a deal that you think is a 15% return. It could become a 40% return if there is cap rate compression. And on the other side of the coin, if rates stay high for a long time, we're where cap rates probably were for, the decade of the 90s or the 2000s. I mean, there's plenty of times where cap rates were mid fives, where interest rates were in the 5% range. And ultimately, if rates stay high for a longer time, it's not just staying high for the heck of it. It's because inflation is stubborn and it's not coming down, and the Fed is taking a stance to continue to try to depress inflation. And one of the biggest factors of inflation is actually housing. So that leads me to believe that if rates are high, granted, operating expenses may go up as well, but I think that means that the rents are likely to stay higher for longer. And see a chart here on the 10-year and cap rates.
I just pulled this up, and you're right that market cap rates. This is the highest that we've seen since. I mean, say roughly 2011, 2012.
Yeah, it looks like I'm just looking at like the end of 2011. It looks like it was, just about right a six. Mm-hmm. Yeah, and that was pretty much the bottom of the market was sometime in 2010, 2011 when things really started stabilizing. And again, that was the Great Recession. That was far different than things are now. The stock market was decimated. We had major banks failing, potentially, AIG, one of the largest insurance companies, failing. That was other than that was the worst since the Great Depression. Right now, you've got, stock market at record highs. You've got record low unemployment. This is somewhat of an engineered crisis, and it's only in very specific markets with very specific sellers that are in trouble, and everyone else is sort of sitting on the sidelines with long-term fixed rate debt, both on the residential side and with a majority of the commercial market outside of, obviously there's office space and retail have their own challenges, but for the most part, the market is, a lot of sellers are well capitalized with good debt and are have dry powder to take advantage of the sellers that do have some distress.
Yeah, no, it's a good time to be a buyer. I imagine if we do see more distress in the market, deal volume will pick up. Otherwise, it'll continue to stalemate, and we'll have to really find the needle in a haystack for these good deals that are out in the market in the different growth metros that we're following.
Yeah, and what's great about our model is it's very difficult to find those needles in a haystack, but because we're on the fund side and we're investing in these deals with a select group of partners, we have a number of partners all looking at those 200 to 300 deals to find those one or two that pencil. So we're generally finding 6, 7, 8, 10 deals a year that are just rock solid, rock star deals that are coming to us. And given the fear in the market, it's not as easy to raise capital as it was a few years ago. So we've got great partners that in some cases didn't need help raising money, didn't need people to participate a few years ago. They were oversubscribed, and now there's great opportunities for those of us that love to invest in private real estate deals, private real estate funds, and syndications. So I'm pretty excited about the pipeline of deals coming down this year.
Absolutely. So, Jack, if anyone wants to connect with you, to reach out to us, to find out about the deals that we're looking at, what's the best way that they can do that?
So jkaminvestments.com, and we have that in the show notes. That's our website. We're also on all major social media. We do have our Facebook group, the Alternative Investor Mastermind. So if you're a Facebook user and you like joining groups, there's some great dialogue. We post some exclusive content on there. Check out the JCAM Investments YouTube channel. and also Instagram, both for Jkaminvestments and Jack Krupe. I actually just got my blue check mark for Instagram and Facebook, so I'm fully verified, and we'll see if that leads to a larger following or not. But yeah, please reach out on any of the platforms and let us know if you have questions or things you want to us to address on a future episode. And as always, Spotify, iTunes, leave us a review if you like what you're hearing for our podcast.
Sounds great. Well, Jack, I think that's the show. Thanks for having me on again.
All right. Thank you. And we'll see you all in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.